Should you be doing a backdoor Roth IRA? I'm going to tell you when to use it, how to set it up, and then the big costly mistake that you need to avoid. All that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. If you are new to this channel, do me a favor, hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, the backdoor Roth IRA, kind of catchy to say. We've been doing backdoor Roth IRAs since before they were even called backdoor Roths. So why would you do it in the first place? How do you do it? And then what's the big mistake to avoid? We do comprehensive financial planning, so I see this mistake a lot. It's very common. I'm going to help you avoid it here coming up. So here's the deal. Why would you ever do this? Well, the reason you do it is if you make too much money to contribute directly to a Roth IRA. And too much money for a joint tax filer, it starts phasing out. And if you make more than $206,000, you can't contribute directly to a Roth IRA. Well, that's problematic because the Roth IRA, it doesn't help you with your taxes today when you make that contribution. But all of the investment activity that happens inside that Roth IRA, all the interest, dividends, anytime you sell something, all of that's tax sheltered. You don't have to pay, you don't have to report those dividends on your tax return every year. You don't have to report the capital gains when you sell something and buy something else. So it's all tax sheltered. And then as it grows, when you pull that growth out, after age 59 and a half and after you've had a Roth IRA for 5 years, that growth comes out tax-free. So if you're making above $206,000, that tax sheltering is extremely important, and being able to pull dollars out in retirement tax-free is significantly important. So let's say you've got good income, you've got maybe various sources of income, and you make $250,000 a year. Through your employer, you're maxing out your contributions pre-tax to your 401k, but still you want to save more for your future, and your adjusted gross income is more than $206,000. How do you get money into a Roth IRA? That's the why. Enter the backdoor Roth IRA. And where this came to be is when they changed the tax rules and removed the cap on being able to do a Roth conversion. Back when I started in the business 20 some years ago, you weren't able to do a Roth conversion if your adjusted gross income was more than $100,000. That seems crazy. Most of you listening to this are probably like, I don't remember that rule. Yeah, you couldn't do a Roth conversion if you made more than $100,000. Well, they removed that limit, but they kept in place the idea that, well, if you make too much money, you can contribute directly to an IRA, but you make too much, you can't deduct that contribution. And then once it's in an IRA, you can then convert that IRA to a Roth IRA. So if you make more than that $206,000 and want to get money into a Roth IRA, the backdoor Roth is for you. As always, work with a certified financial planner because there's a few issues here that you need to be working through. Number one, is this the best place for you to be putting money? I love it. So ideally, I'd like it to be yes, but you've got to look at your own financial situation to make sure. But then there's a few other issues you've got to consider with this. Number one, here's how you do it. You're going to open up an IRA and a Roth IRA. Open them both at the same time at the same place. We use Fidelity, they're a low-cost provider, very easy to work with. And so open an IRA at Fidelity, open a Roth IRA at Fidelity. Make sure you label the beneficiaries correctly so if something happens to you, the money, the accounts go to the right people. So then you're going to fund your IRA, all right? If you're younger than age 60, that limit is $6,000. If you're 50 or older, it's $7,000 in the tax year that I'm recording this. I don't know when you're watching it, but you make that contribution to your IRA. And I know what you're thinking. You think contribution to an IRA, well, I get to deduct that on my taxes. No, if you've got a retirement plan at work and you make more than $206,000, you can't deduct that on your taxes. So it's an after-tax contribution. You contribute to your IRA, but you don't deduct it on the front page of your tax return. And if you even tried, they wouldn't even let you. But once that money is in your IRA, you then do a Roth conversion and convert that money from your IRA right over to your Roth IRA. Now, you made a contribution legally after tax to your IRA. It's not deducted, and then you convert it from that IRA to your Roth. Now the money's in your Roth IRA. You can invest it however you want. Okay? Here's the big mistake that I see people make all the time. You want to contribute after tax to your IRA, but you already have pre-tax money in an IRA. If you've got pre-tax money in an IRA and you contribute after tax, and then you try to convert just that after-tax money to your Roth, you're not allowed to do it. You are not allowed to do it. Those Roth conversions go proportionately. So say you've got $45,000 in an IRA that's pre-tax, you add another $5,000 to your IRA and you don't deduct it. Now you've got $5,000 of after-tax money and $45,000 of pre-tax money. You go to convert $5,000 of your IRA to a Roth, it's going to take $1,000 roughly, $500 of your after-tax portion and take $4,500 of the pre-tax portion, and you're going to have to pay tax on that $4,500. Avoid that mistake. Many people try to avoid that mistake, and they say, well, I've got an IRA, say at Vanguard, I'll open an IRA at Fidelity, and I'll just convert the Fidelity. No, the IRS has closed that loophole. That does not work. When you're converting dollars, looking at pre-tax or after-tax dollars, they aggregate all of your IRAs except inherited IRAs, all of them. So the big mistake people make when funding a backdoor Roth IRA is if you already have a pre-tax IRA out there. You've got to get rid of that pre-tax IRA before you would do a backdoor Roth. Otherwise, the backdoor Roth IRA strategy may not be in your best interest. So that's why to do it, that's how you do it, and that's the big mistake you need to avoid. You've got to fit all of this into your comprehensive financial plan though, because you need to have the cash flow to do this. You've got to make sure it's appropriate and it's in your best interest from a tax standpoint. You've got to figure out the best way to invest these dollars, and then you've got to see how this all fits together with your overall retirement plan. And as I mentioned, make sure beneficiaries are set up accurately as well. So it touches right there. It touches 5 out of the 6 areas of your financial life. Make sure that you're doing comprehensive financial planning, looking at how all 6 areas of your financial life fit together to see how does the backdoor Roth IRA, does it fit for your situation? Work with your CFP, who's a fiduciary, who's doing comprehensive planning with you. We call it One Plan. If you don't have a CFP in your life and need some help, maybe have a question about should you be doing a backdoor Roth, you can always contact a member of our team. Find us online, korhorn.com, that's Korhorn with a K, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.